Hello, good afternoon, everyone. Good afternoon, and thank you so much for joining us here today to hear our expert panel sharing their thoughts on the question, is 60/40 dead? I am Ann O'Brien, Chief Executive Officer of CFA Society San Francisco, and it's my pleasure to welcome our panelists, Omar Aguilar, Chief Executive Officer and Chief Investment Officer at Schwab Asset Management, Anastasia Amoroso, CFA, Chief Investment Strategist and Managing Director at iCapital, and Jeremy Siegel, economist and Russell E. Palmer Professor Emeritus of Finance at Wharton University of Pennsylvania. You will all be muted during this webinar, but we welcome questions in the Q&A box and will endeavor to answer as many of those as possible. Now I invite John Jordan, President of the Board of Directors, CFA Society San Francisco, and our moderator for today's event to launch the conversation. John, please.
All right, well, thank you, Ann, and a big thanks on behalf of CFA Society San Francisco to all of our esteemed panelists today. This is a topic that we've all heard quite a bit about, looking at the challenging year that we had last year. 2022 had considerable stress posed to the 60/40 portfolio, which is the benchmark for many investors. One of the worst years in history, with the S&P 500 down 18% and the Ag Fixed Income Index down 13%. As we've seen as well, the Fed has quested to combat inflation. We've seen rates rise considerably, and one can even now see pretty attractive yield on the short end of the curve in ultra liquid investments. A year ago, yield was nearly non-existent without taking excessive risk. So let's get into the conversation here. Obviously the stakes are much higher after the very difficult year that we saw last year. And so what I'd like to pose to the panelists is, how has the 2022 repricing across stocks and bonds offered renewed opportunities or renewed risks that you see, and are you bracing for more pain or more opportunity as it relates to the 60/40 portfolio? So this is a broad question. It is essentially the topic of this whole webinar. So I'd like to just have each of you spend just no more than a minute. Let's call it 30 seconds to a minute here. We'll start with Professor Siegel.
Thank you, John. I think 60/40 is dead. I think that the real yields are too low on bonds, and the real yields are high enough on stocks that we should be moving to 75/25. Also, we find that the correlation between bonds and stocks does increase when the Fed is fighting inflation, like last year. Outside of fighting inflation, you do get the hedge with bonds. They do move opposite than stocks. We saw that the financial crisis. We saw that with the COVID crisis. In both bear markets, the bonds have moved up. But when they're fighting inflation, they move together. They did it in the 60s and 70s, and now they did it last year. So that correlation, that inverse correlation, which was so attractive, is really lost. Now, we may get it back, but real yields are still too low, in my opinion, to make 60/40 attractive. And in summary, I advocate moving to a 75/25 equity bond portfolio.
Okay, thank you, Professor Siegel. Let's move along to Anastasia, please. What are your thoughts?
Well, I think the 60/40 portfolio has died, I guess, last year. And by the way, it's great to see everyone. This is not a good way to start here. It's great to see everyone. I think the 60/40 may have died, but I do think that in its classic shape may be back from the dead this year. I do expect that after the reset that we had last year, stocks can fare somewhat better, especially if our expectation of the Fed finally pausing and inflation easing comes to fruition. And I do think that we've seen a massive reset in bond valuations. And if you look at a 15-year window, stocks are sort of middle of the road cheap, but bonds have gotten to be as cheap as they have been essentially in the last 15 years. So that's great news for the 60/40. And if you look at the forward-looking expectations for large cap stocks, for the Barclays Ag, a lot of the managers who do these forecasts, the capital market assumptions, they've been revising them much higher given this recent valuations. So for those reasons, I think 60/40 has a chance to come back from the dead. Having said that, I think taking a step back and thinking structurally, are there better ways to construct portfolios? And is there something else that we should be considering to enhance the classic 60/40? The answer is absolutely yes. And that answer has to do with alternative investments and the opportunity set that is available there. Can we supplement the 60 with not just the public equities, but private equities? Can we find opportunities in venture capital and buyout and other parts of the private market? The answer, yes, is absolutely. Can we potentially increase the rate of return on fixed income by considering things like private credit? Yes, of course. And then the last point is there's another reason why somebody should add something to the portfolio is that it offers a low correlation to everything else in the portfolio. And as Professor Siegel was saying, well, 60/40 correlation is not what it used to be, but this is why we look to the opportunity set in hedge funds, multi-strat hedge funds, as well as macro that actually do have a very low correlation with the rest of the 60/40. So I do expect a better year for the classic 60/40, but long-term portfolio construction does still argue for other opportunities like alternatives in it.
Right. Thank you, Anastasia, and would love your thoughts. Last but not least, Omar.
Well, thanks everybody for having us. This is always exciting to be able to talk about, portfolio construction, markets, and in general, how we think forward. A few things in the structure of what even the title of this seminar is 60/40 dead. The 60/40 dead was dead even before 2022. I think the 2022 in my mind was just the nail in the coffin where made everything clear that a 60/40 structure was probably not going to work at all times. And let me explain why I think that way. The challenge is that, this low debt of the 60/40 started actually with the actions of the Federal Reserve. In other words, the fact that the Fed created these, decade of low interest rates that basically propelled risky assets to be, extremely overvalued at the expense of bonds, basically ended up saying that if you look at the 60/40 for the last, 10 years, the majority of the attribution of returns and risks came from equities. And in many cases, what that actually means is that you basically never got the diversification benefits that you always wanted to have. You were just dragging the bonds all along. And of course, when you wanted to have them, it didn't work. And so overall, while 2022 in my mind was just a bad year overall and ended up, suggesting when I think, but other factors like inflation and higher rates and monetary policy tightening that basically by definition usually tend to have higher levels of correlations among asset classes, that actually was just the last consequence of why the 60/40 didn't actually perform as people expected to perform. But the problem was actually much bigger. The problem started just way back. If you think about it, at the beginning of 2022, valuations on equities were extremely high. And as you mentioned, yields were nowhere to be found. So what did people expect that was going to yield? If you go to an overvalued asset class that, in the aspect of, higher potential inflation with the prospects of the Federal Reserve raising rates, the expectations were probably way wrong just to think that it was actually going to work. So overall, there is a lot of things to go forward. I think agree with Anastasia. If anything, we actually may have a better outlook for 60/40 starting this year, just because the Fed is going to be probably not taking as a big of a driver's seat for the 60/40 now that bonds actually have a role.
All right. Thank you, Omar. And actually, let's stay with you here for a moment. I have a question. You have an interesting purview into the mind of the individual or retail investor in your role, I'm sure. And so obviously, whether you're a retiree, an individual investor that's relying on a 60/40 type of portfolio to provide income and as a retirement nest egg, or whether you're an individual investor that maybe got over their skis in terms of trading their own personal account over the last number of years when there was easy money to be made. How have you seen, from a behavioral finance perspective, the individual investor's time horizon and mindset change based upon what happened last year?
Yeah, well, great question. And yes, here at Schwab, we do a lot of research on behavioral finance on, and trying to, get a sense of, where the different clients, are in terms of reacting to their investment strategies. And definitely, the shock that people will have and continue to have when they see both their equities and their bond portfolios basically having negative returns for the year, to the extreme that you mentioned at the beginning, clearly is something that affects their behavior. And their questions that we get all the time is precisely this: should we actually start moving more money to cash? Should we actually just stay out of the market until things get better? Do we need to wait until the Fed gets to their terminal, rate and their tightening until we start getting invested? So that particular thing, which, again, in behavioral finance setup, is really more that setup of either anchoring, which means they're basically trying to go back and see what periods of time with high inflation, higher interest rates, and how assets perform, what is going to happen with recession that basically brings up the risk aversion, that obviously it's a big component, which means they want to basically go exactly where they shouldn't go, which is they want to go to short-term and cash. And then the last thing, it is really more these recency bias, which is probably something that has accelerated a lot of this reaction, which is people are looking at performance and markets every single day and every single data point, and they're looking at media and they're looking at information so that they know next CPI print, oh, this is the end of inflation. That means that we actually now can go back into equities. Or the next unemployment data, well, that means the Fed is going to pause. So that particular recency bias creates a lot of noise that eventually translate into potential poor decisions.
Thank you, Omar. I'd invite Professor Siegel if you have any thoughts there. I know you've done quite a bit of work around this topic.
Yes, and Omar brings up a very important point. We shouldn't just decide what's going to be good for this year. We should try to think of setting up a portfolio for many, many years. I actually think stocks and bonds are both going to do well this year. I think interest rates are going to go down, so bonds will do well, and I think that's really going to spur stocks also. But we have to think of the long term. Is it a good portfolio for the long term? We at Wisdom Tree have done simulations where we have put historical data in a computer for a 30-year retirement portfolio and simulated with all the historical data, bonds, market returns, and stock market returns. And what we found is that the probability of running out of running out of money for a given withdrawal rate is often lower at a 75-25 than a 60-40 because of the income differences and return differences between stocks and bonds. Now, we all know that stock returns have gone up recently, bond returns, have gone up recently. But as I look, the 10-year tips, inflation protected is 1.15%. That's 1.15% over inflation. The long run real return on stocks is 6.7. Yes, stocks are more volatile in the short run, but they're not necessarily more volatile in the long run. And we find that actually it is a very flat probability between 60-40 and almost 100% stocks of running out of money using historical data with the real returns that we see now. And of course, everyone knows the higher the percentage of stocks, if you don't run out of money, you're going to have what's called a higher legacy terminal value at the end of your portfolio. So with very little risk increase going to 75-25, a big legacy increase, we see the arguments for moving towards a more aggressive equity portfolio. Let me just mention, TIPS came out the inflation protected securities. And of course, we're talking about real consumption, so we should be talking in terms of inflation protected. In 1997, when they came out, they were 3.5% the 10-year after inflation. It subsequently moved in 2020 to almost 4.5%, and then started a long, steady downturn, which turned it to negative 1.5% at the beginning of last year. The Fed, by pushing up interest rates, moved it up almost to 1.75. It's now fallen down, as I just mentioned, to 1.15. I expect it to continue to fall below 1. So we are in a world of lower interest rates, not just the Fed that's causing lower interest rates. It's slower population growth, slower productivity growth, aging populations, more risk aversion. There are fundamental demographic and real economic factors that are causing the decline in real interest rates. Yes, they've blipped up because of the Fed's move, but I expect that resumption of decline to continue toward the end of the year. There has been no relative decline, except of course for last year, in the real return on equities. In fact, my first edition of Stocks for Long Run, which was published in 1994, using data through December of 1992, showed a 6.7% real return. I just finished the 6th edition, came out last September, 30 more years of data. And guess what? In those 30 years, 6.7% real return on equities. No decline. I'm not predicting quite that high for the next 3 to 5. 5 years. I'm predicting about 5 to 6%, given ratios that we have, but still overwhelmingly better than what we see at the bond market, even with the tightening that the Fed has accomplished.
Well, thank you, Professor Siegel. And, actually an interesting question has come in, and, I'm going to pose this one first to Omar. What portfolio recommendations for retirees in their 80s would you make in controversy about the 60-40 portfolio? So it'd be interesting to hear your thoughts. Obviously you have to be cognizant of risk when you start dealing with an individual that is longer in years and that may have a higher risk of running out of money. So Omar, let me pose this to you first, and then perhaps Anastasia and Professor Siegel, you could also share your thoughts or any thoughts that you're willing to share there. Thank you.
Yeah, well, no, that's a great question, and one that obviously we work a lot with people as they think about their portfolios and their needs. And the answer on all these, it starts with basically saying what are the needs of this strategy and what is it for? When you have somebody that is retired, is 80 years old, and basically it becomes a liability, setup, and trying to understand, what is the lifespan, what are the different things, what are the income needs, and what is the risk aversion of those components. Equities in general, when you think about risky assets, they provide the growth, so you grow your pie. You provide the fixed income and cash, where you basically generate certain income so that you can actually have payouts, and you actually lower the probability of potentially having those low payouts. So in many cases, what we offer, or what we try to do in general, because every single individual has a specific needs, is that when you actually start getting close to retirement and in retirement, the components that you have to worry is precisely what we're living now. You got to mitigate inflation risk. You got to mitigate the fact that your income, your real income, is now going down, which means in many cases, I think as to Professor Siegel, that actually means you have to increase your exposure to risky assets and growth, because your real income is coming down. So if you think about it, just as a very simplistic example, if you rely on, say, a check that comes every month after you retire, if inflation starts to going away from the norm of, say, the 2% that the Fed wants to have, all of a sudden your real income for that check is basically doesn't allow you to pay for your food or for your rent or for any basic levels, which means that you need to grow your pie again. So, I would probably say, and again, this is just probably too much of a detailed answer, is in a normal circumstance, meaning inflation is at, regular levels, say at the average of, 2 to 2.5, when you basically have normal, cycle of rates, and would you actually have a normal non-Fed driven, capital markets, and you see for the long run, normally for people that are in that age group, we basically ended up having significantly more bonds and cash than when you have equities. And what that means, instead of the 60-40, you ended up going closer to, 75% in fixed income and 25% in equities. Now, I would probably say that today in this market environment, those ratios are probably not going to last unless inflation comes back to a normal levels.
And John, I'll jump in here and I'll agree with both Omar, what Professor Siegel has said about the fixed income. Even though we had the repricing, the traditional, Barclays Ag fixed income is probably not going to be enough to meet those target rate of returns for an investor profile that we just talked about. And one of the reasons I say that, first of all, you look at that set of capital market assumptions that have been revised higher, but for the traditional fixed income, it was revised from 2.7% average annual return to 4.7% average annual return over the next 10 years. So if it's 4.7 and inflation is still, well above 2%, that's obviously not going to get you to those real returns that you're really after. So what the recommendation that we would have instead is we've got to expand our thinking beyond the 60-40, or maybe we expand how you think within the 60-40 and what is within the 60, what is within the 40. And of course, what I'm alluding to is a number of alternative investment strategies. So we recently went through the exercise to see how can we potentially enhance the risk-adjusted returns on a conservative, moderate, and aggressive portfolio by embedding various alternative strategies into the mix. And so there's a couple of findings from that. So first of all, the optimal allocation that we found, given a number of different constraints, is 22% across conservative, moderate, and aggressive profile to alternative investments. But obviously, the mix of which alternative investments you're going to have for a conservative investor versus aggressive is going to differ quite significantly. So for an aggressive investor, we would be looking for an allocation of 8% to private equity, for example, and only 2% to private credit. And so, again, going back to Professor Siegel's your point about, maybe it needs to be 75% and 25%. Well, maybe we're in a way with you, because you can still have 60% of public equities, but if you add that close to 10% private equity sleeve, that's one way to increase your overall equity allocation. So that's for a conservative profile. If you think for an aggressive profile, if you think for a conservative investor, the mix of alternatives within that 22% bucket would change pretty significantly. And instead of 8% or 10% in private equity, you might only have 6%. And instead of, but you might have 5% in multi-strategy hedge funds. You might have 2% in infrastructure. You might have 6% in private credit and real estate. So there are ways to solve for the aggregate, bond return that's still not adequate by embedding some of those other alternatives into the solution. And, I'm sure a lot of you on this call are familiar with opportunities in private credit, but if I can get a yield of 10 or 11%, versus, 4% in the overall bond market, that's pretty significant. And the last point I'll make about that, we had a huge repricing in yields, but first of all, the forward-looking curves are already discounting that yields will revert back to 3.5%. And by the way, the 10-year yield moved from 4.2, 4.4 to 3.4% today. So this repricing has been quick and is starting to be quick to reverse. So for those reasons, even for an income-focused investor, I would say you need to have something more durable that can provide that yield. And we would look to some of those alternative strategies.
All right, thank you, Anastasia. And I will stay with you for a moment here. Actually, a question came in that I think would be an interesting one to pose to you. And, regarding private assets in balanced portfolios, do you think the illiquidity premium will remain in that historical 3 to 5% range going forward? Or do you expect that illiquidity premium to shrink a bit?
Yeah, I think it will shrink somewhat. And again, referencing some of the latest revisions, just focusing on private equity, for example, there was a huge expected outperformance gap from private equity versus private markets to the tune of 400 or 500 basis points. That in the latest assumption is shrinking to 200 to 300 basis points. But the point is there is still an illiquidity and an outperformance premium to be had. And it makes sense that it would be somewhat less than it was in the past for a couple of reasons. If you think about buyout private equity, for example, it's been a stellar 10, 14 years for the space because you had basically three drivers of returns there. You had zero interest rates that allowed very cheap debt financing, and that could boost the returns. Well, that's not available anymore. You had multiple expansion that was propped up, again, by the ZIRP and quantitative easing and everything else. And so a lot of the private equity companies cannot count on the multiple expansion that we have seen in the last 10 years. So that's going to naturally, subdue the returns. But the third driver of returns, I would say, is still available, and that is growing the revenues, growing the profitability of the companies, going from, no profitability to path to profitability and eventually an IPO. That's still very much a resource, a revenue stream or a return stream that is available to private equity. So I personally think of it not as much in terms of, are you getting paid for this illiquidity, but how are you getting paid for it? And so maybe two of the return drivers are going to be less going forward, but one of them, which is the ability to grow and scale that companies, I would say still very much there. The last thing I would say on this, what makes us so sure and so confident that, that revenue growth and earnings growth opportunity is still there. If you think about, innovation that everybody's chasing, like artificial intelligence and gene therapy and decarbonization, some of it is available in public markets, but a whole lot more of it is available in private markets. For example, there's 58 times more AI companies that are private versus public. And so the opportunity set is rich. The opportunity to, build companies by bolting some of them together is there. And I think there's a lot of creative combinations that are still to be had out there, and private equity managers will take advantage of. So perhaps somewhat less of the liquidity premium, but nevertheless still there.
All right. Well, thank you, Anastasia. And another question came in around thinking about, asset classes that are, typically in private structures like private equity. For the smaller investor, are liquid alts a viable option to as a way to enhance the 60-40 portfolio? And maybe we'll start. I think Omar might have some interesting insights there, but would love to hear any thoughts from Professor Siegel, from you, Anastasia, around liquid alts. Thank you.
Yes, John, and I got to tell you, I do have a problem with just the term liquid alts. I think in many cases, when you think about the concept of alternative investments, outside of the traditional infrastructure, commodity, alternatives, as some people might want to use them. When you talk about hedge funds, private equity, private real estate, private assets in general, I think the question you asked before, you're talking about transferring the risk that you have in your typical 60-40, and then the risk that you have, you're moving it to a liquidity premium. In other words, you're trying to basically squeeze out the liquidity that you had in just traditional, public masters, and then you're trying to move that so that you can actually take the benefits of the spreads that you get in the low correlation, or, or the fact that you expect those assets to grow faster. I think Anastasia, hit on one big thing, which I go back to what my initial comments were, is, those asset classes had a great run because financing was free. In other words, you were able to just take advantage every single day for the, more than 10 years of the fact that you were able to just exploit that, component, even when the markets were fairly liquid. So just think about what this may actually mean, going forward. And again, liquid alts, I do have an issue because, in order for you to just continue to enhance, your portfolio with what you want to have on alternatives, by definition, you need to have the liquidity premium. And that actually means in general, you cannot mix them both, because trying to use those, just because you're trying to find arbitrage opportunity, in my mind, that just mining data as opposed to have some fundamental strategy that takes advantage of the structure that Anastasia talks about of companies that are not public, and therefore they have access to certain people and provide that extra liquidity premium. So in general, for me, as you transfer assets, and this is not just on that area, it also applies to, say, credit markets. When you actually think about that 60-40 mix and you say, well, I'm going to have my bond portfolio, but it's all going to be bold on high yield. Well, guess what? You're basically just transferring the liquidity, and you're basically transferring the risk in equity-like risk to credit, as opposed to try to take advantage of the correlation structure that we talk about in the 60-40. So when you think about the allocation to liquid alts, the track record that most of the ones they have is they tend to have high fees, and they tend to have probably a questionable level of long-term performance of taking advantage of that liquidity premium. So when you bold that, and you can mine the data, and we have done a lot of work on this, if you think about the performance of the 60-40, just the benchmark, normally you get between 6 and 7% on average. And in fact, if you take the last 10 years, including last year, you still get that around 6.5, mostly because of, I think, what Professor Siegel said, mostly because equities have actually done that. Now, in general, if you bolt on just traditional liquid alts, what is available there, you don't really get that level of extra enhancements. You actually have to take advantage and going deeper into the liquidity premium to be able to take that enhanced, efficient frontier that we're talking about here.
Thank you, Omar. I'm curious, Professor Siegel, do you have any thoughts around liquid alternatives that you'd like to share?
I don't on that subject, but I do want to talk about 60-40 and the question that was posed by your listener, I think an 80-year-old person, about what kind of portfolio. We talk about 60-40, and no one has talked about time horizon. The longer the time horizon, the more you want to be in equities. Now, we often talk about a 30-year portfolio. We also have to talk about, are you wealthy enough that legacy is a big part of that, or do you have to live off of your retirement portfolio? Now, let us suppose you're 60, healthy. You probably can live to 90 or more. 30 years is a good consideration. You can put that in a TIPS annuity right now, and withdraw about 4 to 4.5% per year, guaranteed purchasing power, and then run down to zero at the end. If you're worried about, you can actually buy annuities that will protect you against living longer, but just using that as an example, 4.5% per year. I guess I'm doing this in my head for per million, that's a $45,000 of purchasing power per year. And that would get you down to zero at 90. So that gives you an idea of how much do you need. If you have many millions and your consumptions level allows you to give legacy, then you have to think very differently about 60-40, about having equities, about what Anastasia talked about, that you can be much more illiquid because you don't have to draw down every year. You can leave either to charity or your children or grandchildren or whoever you want assets that they can hold also for a long run. So I think that we talk about 60-40, and I think that's oversimplified for what we need. We need to go to the individual and say, as all good advisors will do, well, what are your assets? What are your consumption requirements? What is your desire for legacy at the end? Then we can really answer the question of 60-40 much better. The more you value legacy, the more you're going to be in equities, and the more you're going to be in illiquid assets. If you're on a tighter budget and portfolio where you won't have much of a chance for legacy. Then you've got to think about really immunizing your portfolio, and maybe a TIPS annuity, which is really 100% inflation protected bonds, might be the best for you. So I think that we all have to make these broad considerations when we recommend to the general public or to any individual what is the right portfolio.
Great points. Thank you, Professor Siegel. And I had another question come in that I think is quite interesting. And this is the last probably dive we'll have time for into alternatives. This question is around thinking about, are any of the panelists concerned that performance is not always what it seems? Returns being overly smooth, assets not properly marked to market, et cetera. Perhaps Anastasia, you could address that first, and then would welcome the other panelists to chime in as they see fit. Thank you.
Yeah, happy to address the performance, and then just a quick comment on this idea of liquid alts as well. Look, it is known widely that the performance in private markets usually follows with a lag. And that lag can be significant of 6 to 9 months, in some cases 12 months. And so just to put some numbers around it, through the first half of 2022, the 60-40 portfolio was down 17%. A private markets portfolio of real estate, private equity, and private credit was up plus 4%. So that's the significant outperformance there. And I think most of us would agree that, well, the degree of that outperformance is probably not going to last. And as we start to have a look at some of the numbers that we see in Q3, they are starting to soften for private equity, for venture, for private credit. I mean, really across the board, for private real estate as well. And I think you should expect, like, one of the things that we would expect is in 2023, it is highly likely that the private markets portfolio probably underperforms what the public markets portfolio may do. And, one other way to think about this, if you look at the buyout private equity multiples, going back to 2008 to 2009, from 2008 to 2009, you had big reset in valuations in public markets, and then they snapped back as the markets rallied. And then you had the opposite happen in private markets, where they were sort of artificially high, through 2008, but they corrected sharply in 2009. So I think that's likely the setup that we're going to see this year as well, is the private market multiples will reset lower, and you're going to continue to get markdowns. Now, I don't think the reason why you're not seeing the appropriate marks is because people are trying to not reveal the truth about the companies or anything like that. It just takes time, and it takes reporting. For example, we go to PitchBook, we go to Preqin, and we say, what are the real-time valuations for these companies? And it takes months and months and months, 3 to 6 months to compile the data. So, I don't think it's for the lack of trying. It's just that how data intensive the collection process is. The other thing I would say, market conditions change very quickly. And if you have a mark on a private asset, this week, it might be very different 3 months from now. So that's one of the advantages of being in private equity, being in private credit, is you don't get the whipsaw of the public markets. PitchBook puts out this measure called Private Equity Barometer, and it tries to forecast the private equity returns given a variety of macro factors. Guess what? The returns were softer in Q3, but in Q4, they actually were forecasted to be up 4.9% because of the snapback in macro conditions. So, why try to get whipsawed as the public markets do when in private markets you have the luxury of seeing how things evolve over a period of time? So that's kind of how I think about that performance. But yes, by all means, we will likely see more of a correction in valuations and performance this year. One other quick point on liquid alts. I am a big fan of expanding access to alternatives and making sure it's not just accessible by, institutions and the world's largest sovereign wealth funds and pension funds, but it's accessible to investors as well. However, there's the right time and a right place and a right form to do this in. If you think about this whole notion of a liquid alternative, something that presumably would have daily liquidity, but is backed by an illiquid asset, that makes very little sense. So I would be very cautious with the idea of, daily trading liquid alternatives, because there's an inherent liquidity mismatch. Some of the structures that we have seen are semi-liquid, where you get the income paid out to you, and if you were to request a distribution, that might only be done quarterly, or that might be done annually. That makes a lot of sense, because ultimately it's there to protect the investor from having to fire sale the assets. So I am much more in favor of structures like that than having the liquidity mismatch that you risk with liquid alternatives. So right place, right time, right structure.
Thank you, Anastasia. Yeah, before we pivot off of alternatives, I'd ask very briefly, since we're running out of time, but Omar, Professor Siegel, do you have any comments to react to what Anastasia said?
I think what she says is right. If you had a trading asset representing an untraded asset, it would be much more volatile. We see that REITs versus the public markets. One has to remember, if you were trying to sell your house, let's say the day after Lehman went under, or let's say the week of March 20th, right, 2020, when COVID was, we were all in fear, and you said, I just have to sell, and everyone's frozen, and they would give you 50 cents on the dollar. Now, if you waited, you're going to get more of your money back. The public markets are priced every day through panic, through anxiety, through crises, and they're going to show much more volatility. But the research shows that over time, that volatility gets smoothed out. And so we all get nervous on public markets that are daily quoted because they seem so volatile. But for equities, at least, the evidence that I and others have measured is that volatility decreases dramatically as the time period increases.
Hey, John, I will probably, I think it's probably, just piling on the same topic, so I'll be really brief. But to me, the challenge that to the question that you ask about whether or not you can use the same sort of time series of returns to just evaluate what is the right allocation for your portfolio to enhance the 60-40, to me, you're just basically talking apples and pears, because, if in order for you to do a proper analysis on how you can actually put that in a sort of a typical portfolio construction optimization process, you will basically have to adjust each one of those for the liquidity metric that you will have and for the needs that you will probably need. I think this goes back to the analogy that Professor Siegel had, which is, if I want to sell my S&P 500, I can do it right now during the day. If I want to sell my treasuries, I have no problem to selling. However, if I want to sell my real estate, I may take me another couple of days, and it's going to be hammered. It's not going to be there. It's going to be a supply and demand issue that will eventually end up lowering. So, the assumption that most of the returns that get published is that people think that they can get those returns, immediately and be compared to the performance you get in the total return with dividends on the S&P 500. And that's just completely mathematically wrong. So the challenge I have in those areas is not necessarily, which I agree with Anastasia 100%, that yes, getting the assets, the valuations and everything else is a different process. The challenge I have is when people try to mix those NAV returns and try to put them in the same model as what you get from the total return capital market expectations we're talking about here. That's the challenge I have, and I will probably encourage people not to do it.
Thank you, Omar. And actually, Omar, I've got another question that I'm going to pose to you first. And I think this is a great one as we come toward the end of this conversation. So when we back up again and we take a look at whether it's a 60-40, whether it's a 75-25, this question from the audience relates to the frequency of rebalancing. Do you have any comments around the frequency of rebalancing and how that impacts longer term returns and risk?
Well, great question. I love that question, by the way. First of all, one of the things that I think we're going to have that is embedded into the 60-40, the 75-25, or any other mixes that you have, which I also agree with earlier comments about those also depend on different factors. 60-40 is more the traditional, long-term, benchmark that people want to use. But in general, the mixes, had to do with your risk profile as well as your time horizon and other metrics. That being said, the number one thing we tend to encourage our investors, to do is to avoid market timing. In other words, if people are actually trying to say, well, because 60-40 was bad last year, I'm going to get out of the market or I'm going to double down, those decisions on themselves over the long run, if you look at the data academically and you look at the data just empirically, they tend to reduce results as opposed to add more value. So trying to outsmart the market is a wrong idea. And, in many cases, what we advocate for folks is to say, have a disciplined process for rebalancing that meets your requirements. And what that means is no matter what it is, you basically set up what is the drift that actually ends up working well with you, that allows you to stay close to your long-term investment objectives and allow to that. And I would probably say that the drift is critical, because in the capital markets efficiency theory, what that does is that if you have a portfolio that you can set forever and don't touch it, never rebalance, that actually has higher probability to give you the results you need than when you actually, if you have more frequent rebalance. So that, buy and hold portfolio is very powerful. That being said, it does affect the behavioral aspect of clients when they see that all of a sudden my equity exposure is taking over, my, bond portfolio needs to be rebalanced. And in many cases, there will be years, multiple years then where you actually don't have what you have. So what we advocate people is to evaluate at least annually for a rebalance and to set a very clear drift of when they need to do that in a systematic way so that they don't have to overreact. The last thing I would actually say in here, which I think may be related to, the comment that was done with Professor Siegel on the changes from 60-40 to 75-25. If you were to do a buy and hold, starting, at the end of the last recession, you will probably be closer to that 75-25. If you let it go, you just buy and hold, back at the end of the last recession, because equities outperform bonds for, quite a bit in the total return setting, your equity exposure will be growing significantly to the point that you may be getting to that point.
Thank you, Omar. Great points. Either Professor Siegel or Anastasia, any thoughts around rebalancing you'd like to add? And if not, we'll move into rounding it out with a final question that the audience has posed here.
Well, first of all, I agree with Omar. Don't try to time the market. And I can understand why holding equities in the long run have done better. So you've done better expanding your equity to 75 by its own internal return. However, I would warn against that with individual stocks, because you would be way top heavy with all those tech stocks that we knew sort of blew up last year. You really don't want to do that with individual stocks. Is just buy and hold. You'll become top heavy in that situation. So I liked our cost averaging, where you sell down things that have gone up more than your expectations, buying things that go down where you still think the expectations are good. That can lead to some very good long-term results.
And I just add a very quick comment, because I think a lot of great points have been made. But as you're rebalancing, I think on an annual basis makes a lot of sense, and taking thresholds into account makes a lot of sense. But I would also take into account, what are the expected returns? What are you rebalancing to? And after a year that we just had, there's been a massive, shift in expected forward returns across different asset classes. So it is possible that the rebalance this year looks a little bit different than a rebalance a couple of years ago may have looked like. So taking into account just with the forward expected returns, standard deviation, and the forward-looking correlation as well. That's an important part of the rebalance process.
Thank you.
Hey, John, if I may just say one last thing on the rebalancing, because I think it's critical, which we have encouraged people to do this, especially as volatility increases. one of the things that on a systematic, rebalance strategy that is beneficial is you can use that for tax efficiency. In other words, when you actually think there are certain asset classes that have, lost value, like last year was perfect, you can still maintain your exposure to your 60/40 or your mix, but change the underlying security so that you can take advantage of those tax, efficiency, setups so that you can be proactive about it. So that's just the last point I would say. Like volatility, is not necessarily bad, especially if you think about that systematic, tax loss harvesting setups that you can do.
Thank you, Omar. Well, we've gotten some amazing questions from the audience, and so I want to thank everyone who's attended for submitting such great questions. I do want to pose one last question, and perhaps we can keep this tight on time since we're already over. I'm going to actually pose this one to Professor Siegel. I know he touched on this in his Stocks for the Long Run book, and the question is really like, when you look within equities, should the composition of equities change, such as a higher proportion of dividend paying equities or value equities as you shift toward a higher allocation to stocks, as you referenced? So when you go from 60/40 to 75/25, how do you actually change the composition of that 60 or 75 stock piece?
Well, this sounds like a question somewhat like the value growth debate. And up until last year, we all know we had the poorest performance by value stocks. Those are the high dividend paying stocks, low PE stocks, relative to growth stocks in history, 100 years of data. Last year was a turnaround. I expect that turnaround actually to continue, because this is what we saw in 2021. About every 25 years, we see a huge boom in growth stocks. We did Nifty 50 in 1975, 2000. All of us remember the dot-com boom. And then, 20 years later, with the post-pandemic fascination with technology, it seems like 25 years is a cycle. And when that cycle changes, it usually changes for 2 or 3 years. And I think we will experience that change in 2023 as we have from 2022. I don't mean that there's not good growth stocks and tech stocks out there. I'm just talking about what history has said happens to these cycles.
Thank you, Professor Siegel.
So I'm coming back in to thank all of you so much for this incredibly interesting and engaging conversation. Thank you, Omar, Anastasia, Professor Siegel, and John, for taking time out of your day to share your thoughts and expertise with our members. I can say this is one of the most engaging panels we've had this year, thanks to your participation. So we really appreciate it. All our many members at large and our investment community writ large appreciate it. As Jonathan said earlier, we are recording this and we put it out for people to view. If you would like us to send that broad and wide to your constituents, we're also happy to do that. So with that, thank you so much again. It was a pleasure to host you. Enjoy the rest of your day. Bye-bye.
Thank you, Ann.
Thank you, everyone.
Thank you.